All right, good morning. Let's review today's trade plan. So in the overnight session, we were using that 55 to 57 as a key area, and ES held above it, telling us that short term buyers are maintaining control. We are going to be using 55 to 57 as the micro bull bear zone, and short term, as long as ES holds above that zone, buyers are in control, and the high odds targets on the upside are the 64 half HVN and the 66 half to 68 half initial resistance zone. Now we're going to be paying close attention to the 64 half high volume node because how the market reacts to that level is going to tell us how strong this market really is. So if we slice through 64 half where we get like a breakout above 64 half, and on the day time frame it'll show up as a low volume area, that'll tell us that there's some pretty decent strength in this market, and there could just be some profit taking at initial resistance, and we could get some rotational price activity, but then we can get another leg higher up into the 73 to 75 zone. So it's going to be important to watch the reaction that we get at 64 half, and then based on that, gauge how strong the market is. Because if we, for example, go through 64 half, but then fail at initial resistance and start trading below the 64 half again, that would tell us that the market is fine. It's short term. It showed some strength, but it's not this, massive trend day or massive upside breakout type market. Perhaps we're still going to balance in a range, and that means that we're not expecting it to fail and completely go the other way, but we're also not going to expect some massive upside. But if we break 64 half and it's a fast break, and then we actually hold above that zone, hold above that level, in that case we can still get some continuation and go up to the 73 to 75. The other reason that we have to be a bit cautious buying too high is that the other markets are still showing some relative weakness to ES, and we want to see some continued strength in the NQ and TF as well. So that's really the primary upside scenario is ES holds above micro bull bear zone, goes up, tests 64 half. There's potential for a breakout there. So, we don't want to be shorting the pop either. We want to be watching it, and we don't just want to fade it blindly. Because short term now, buyers are in control, and we could go up to 66 half to 68 half before we have that potential of failure. And even at initial resistance, it could be a rotation, kind of a balancing above the HVN, and then we get continuation. So we have to be open to that idea. The only time we'll switch our bias is if it's a pretty big failure off of initial resistance where we go up there and then we get some big downside bars on above average volume and we start trading below the 62 half to 64 half zone, then perhaps we can look for the short side. But right now I think the short side is a bit risky, and given how strong this market has been short term, I think that you want to be cautious on the short side. The problem with the long side right now is that we're very close to some upside objectives, and that skews the reward to risk. It doesn't give us that high reward to risk that we look for. So right now, there may not be any trade in this market. There's no conservative trade, at least right now in the market, because we're simply too close to resistance, and with the other markets being relatively weak, it doesn't really make for a high conviction trade. But our bias is still to the upside, and if we're going to take a trade right now, it'll still be on the long side. It's just that we got to get some decent location, and we just have to get the good reward to risk. That's the primary filter. If you're not getting good reward to risk, then it doesn't matter. Just skip the trade. Now the downside scenario is in the event that we break below 55 to 57. Then we can get a move down to at least the 48.75 to 50.75 pre-market support. You have the gap fill over there as well. Now that zone has potential to still get some buying activity, but whether it's the end of the downside move or just a short-term balance and then a move lower, that's something we'll have to determine in real time. It'll really depend on how we break 55 to 57. If it's like a massive liquidation type move, on high tick readings, high volume, in that case, we can get a pop at pre-market support simply because the market would be oversold short term and there could be some profit taking. But bigger picture, we have to realize that we're trading near the top of the recent balance. We're trading in an area where the larger time frame buyers are only going to step in here if they're expecting new highs on the year. They're not looking to make 5-10 points on the S&P. So we have to keep that that time frame in mind, that anyone who's buying up here, they're not doing it to make 2-3 points. The larger time frame players are doing it because they're expecting a retest of the all-time high and a potential break of the all-time high. And you have to question whether the odds are still in the favor of the buyers if you get a big downside move here below the 55 to 57. And because of that, are you still going to get those larger time frame buyers active at the 48.75 to 50.75? So those kind of questions, we do have to watch the price action in real time to gauge some of those things, because if you get a failure here and you go below the bull bear zone, then it could just be a short-term pop of pre-market support, and then if the larger time frame buyers lose interest in the buy side, then you could be coming down to Friday's low, 1845, and even potentially the 40 to 42 support before you get some stability in this market. So right now our focus is still on the long side because we're above the 55 to 57. But I wanted to cover the downside scenario in the event that the upside fails here, because the market is still in this mixed context where it's trying to figure out which way it wants to go. The S&P has been the stronger short term. It is the stronger market. It didn't liquidate as much as the other ones, and it popped back up stronger than the other markets did. So right now you definitely want to be careful, shorting the market even before the market tips its hand. And then the long side, we can still take some longs, but again, just keep that reward to risk in mind. That, like I said, is the primary filter when you're taking a trade. That's how you decide, that's how you differentiate between the high quality setups and the low quality setups. That's a key metric that you can measure. If it doesn't have good reward to risk, then even if it looks like it's going to go a bit higher, short term, let's say you're expecting it to test, the HVN or even initial resistance. If the reward to risk is not there and you're not getting good trade location where you can use a tight enough logical stop that makes sense, and then have your target far enough, then you want to be careful. But at the moment, the focus is on the long side, and it will remain there above bull bear zone. Initial resistance, expecting some profit taking, but then if we hold above 64.5, there could be a continuation up to the 73 to 75. So let's keep that idea in mind. Let's see how well the market holds up off the open. We have Chicago PMI out about 15 minutes into the open, and after that, we don't really have any big economic catalysts for remainder of the session. But Chicago PMI should give some good information, and we can get a either a continuation upwards or a failure and a reversal following that econ report. So in the first 15 minutes, definitely exercise even more caution, and perhaps even wait for the econ report to get out of the way before you really get active in the market. So those are really the main ideas on the day time frame. Let's see whether we hold above bull bear zone. That's the main idea. Let's see the reaction at 64.5, and then take it from there.